Hi, and welcome to the Market Access. Today we will talk about CFDs. What are they? What do they represent? Where do we trade them? And how do CFDs platforms work? Alright, let's get started. CFDs, or Contract for Difference, are financial instruments that are commonly called derivatives. Their value derives from a second underlying security. When the underlying value changes, then the CFD's value changes accordingly. So basically, CFDs are a bet on the underlying financial instrument. To be a little more precise, CFDs are contracts that represent a bet on the change of value of another security. To be clear, when you buy a stock CFDs, you do not buy a specific stock. What you buy is a contract that will change its value based on how the actual stock will perform in the market. Don't worry, I'm going to provide you with an example to explain this concept better. Before I do that though, I need to introduce two fundamental financial terms that are necessary to understand the mechanics of CFDs. The first one is leverage. The second one is margin. Very quickly, financial leverage represents a loan to invest more than your actual capital. For instance, if you only have $50 to buy CFDs and you decide to use a 10 times or 10-fold leverage, you can buy $500 worth of CFDs. Margin, on the other hand, is the amount of money that the broker requires you to invest to utilize their leverage or their loan. Usually, the margin is represented as a percentage of the total value of your transaction. For instance, if you want to buy $500 worth of CFDs with a 10% margin, then you will have to invest only $50 of your own. If you would like to dig deeper into the concept of financial leverage and margins, I will soon upload a video regarding those two instruments. Let's look at an example to clear up how CFDs work. Sailwest Incorporated stock is trading on the market at $80 per share, and you have only $400 to invest. If you decided to buy the actual stocks, you could only afford to buy 5 shares. However, you did some research on the company and you really like it and truly believe that its stock value will rise in the future, and you do not want to miss out on this opportunity. In this case, you decide to buy CFDs instead. Let's say you buy 100 CFDs of Sailwest stock valued at $80 per share for a total amount of $8,000. To process this transaction, your broker asks you a 5% margin on the total value. This means that you will only have to invest 5% of the total of $8,000. Your investment then is $400. Hey, guess what? You were right. Sailwest stock's value has risen to $88 per share. Now you can sell off your 100 CFDs valued at $88 for a total amount of $8,800. To calculate your profit, you take the selling price, $88, and you subtract the initial buying price, which was $80. The result is 8. Now you multiply that by the number of contracts you had, which was 100, and the result comes out to be $800 of profit. Congratulations! Do you understand how CFDs work? These instruments are extremely enticing because they offer you a large potential of profit with a relatively small investment. Every coin has two faces though. If on one hand profits could be really high, on the other hand, what happens if we made a bad decision? Let's bring up our previous example. You bought 100 CFDs of Sailwest stock at $80 per share. The share's trading price drops to $72 per share. You decide to sell your 100 CFDs to contain your losses. Now, you take the selling price, which is $72, and you subtract the initial price, $80. The result is minus 8. You then multiply that by the number of contracts you had, 100, and find out you have a $800 loss. You're probably thinking, well, yeah, it's fine. If the value goes up by $8, I gain $8. And the same but opposite happens if the value drops $8. But I think we're missing one major detail. Do you remember how much money you actually invested in this transaction? You invested $400. Yup. When you invested $400 and the things went well, you sold your CFDs and your account balance was $400 of your initial investment plus $400 of profit from the transaction for a total of $800. However, if you invested $400 and you took an $800 loss, guess what? Not only you lost your $400 investment, but you also have to pay the broker back for the initial $400 loss he took because he lended you his money to make the trade. Do you understand now why CFDs platforms are extremely dangerous and you must really be careful when you invest on them? This is the reason why every platform shows you a disclaimer before it lets you sign up, saying that on average 70% of retail customers lose their money when trading in CFDs. Thanks a lot for watching this video. If you enjoyed it and it provided you some added value, please give it a thumbs up and subscribe to the channel. I'll see you next time.